We begin our index studies session with the Nifty. Earlier we hinted at an island reversal. Normally an island reversal is not tasted and the market goes down. Here also, at least initially, that happened. The island reversal happened on 16th of January, and after that on 17th of January we saw a gap down and the island reversal was posted. Island reversals happen when a top with one particular bar or candle, or at the most three bars happen, or three candles you find at the top. Those tops making candles are preceded with a gap and they end their journey by falling with a gap, and that thing happened. We found a low initially at 21,285. It happened on 18th of January, Thursday. Then we found a second low. That time it appeared as if the 50-day moving average would also be tested, and that 50-day moving average was then on 23rd of January. It was at 21,065 and the day's low was only about 130 points higher, that was 21,192. It was kind of becoming a reversal signal. Then came the upward journey. That upward journey began with a bang, and it moved up after opening at 21,185. That was 24th of January when it happened, and it started moving up. On the last day, that is last Friday, we see the top. It was a fresh top, all-time high for the Nifty at 22,126.80. Earlier, it was the Saturday prior to the Ram Mandir consecration ceremony. That was 28th of January when it posted a top of 22,124. This time on last Friday, the high was 22,126, just a mere 2 point higher. Almost the same top. Look at the close. It's actually called as inverse spinning top. Inverse spinning top in candle formation. The high is 22,126. The opening was 21,812 and the low was 21,805. So from the opening level of 21,812, it went up to 22,126, more than 300 points. After that, it fell 300 points and posted a low of 21,805 and finally closed at 21,853. This is again suggesting a probable downswing. I call it probable because it was as if the island reversal has been negated. But as we saw, that the island reversal top was bettered by only 2 points. Only 2 points is not even 0.1%. Not even 0.01% rather. So it's a big fall that way. And if now it were to fall, the first level of first support level of 21,640, if that gets taken out, then further downswing might actually happen, and we might see it tasting 21,296 and the 50-day moving average level of 21,203. That is 21,300 to 21,200 would be a strong support zone. Prior to that, 21,640 is another support zone. And finally, if it were to break down below the 50-day moving average, that is the 21, decisive breakdown will mean that the Nifty would go down below the 21,000 mark. If that happens, then we can say that we are in for trouble. We are in for real trouble, that there could be further fall that can happen. The weekly chart, of course, doesn't show that kind of weakness. It is only somewhat a fall after strong rise. So weekly chart still gives such hope, but even the weekly 9-week exponential moving average is located at 203.60. If 21,360 mark, if that gets taken out, as well as the 21,300, 21,200 gets taken out, then we have a real problem at hand. It appears that RSI, despite the fact that there is a significant high that is about more than 1200 points from the earlier high that happened over the last few weeks, the RSI did not post that kind of an upswing. So there is a negative divergence, and probably it would be a fall. We are now reviewing the Bank Nifty. Bank Nifty has again given a signal that it might be headed down, because it tried to take out the moving averages that we follow. It is still taking a support on 9-day exponential moving average, which is at the moment located at 45,864, and the last close had been 45,970, which is 100 points more than the 9-day moving average. But on Friday, it tried to take out the 20-day exponential moving average, which is currently at 46,455. It went up, but it could not sustain itself, and it failed. In the process, it also fell below the 50-day moving average. 50-day moving average also could not provide the required support, and it was pierced in a blast kind of thing, because the stock started coming down midday, and especially the HDFC Bank stock was pretty weak. So the 46,253 50-day moving average level was also taken out. This is the rearguard action that was supposed to happen. Bank Nifty tested. After 3 months, the Bank Nifty again tested its 200-day moving average, and that happened on last 24th of January and 24th and 25th of January. The moving average was tested, that is 200-day moving average that was tested around, say, 44,560 kind of levels. After that, there is a good bounce back that happened, and that good bounce back lasted for about 4 plus 3, 7 trading sessions. On last Friday, it is a reversal. It's a short-term reversal. This time what we need to see is that first we need to see whether the 45,849, 45,850, the 9-day exponential moving average level, whether it is taken out by fresh selling. If that happens, then the possibility, in this time, it could be not just a possibility, it could be a likely probable event that the 200-day exponential moving average for the banks might also get taken out decisively. If it were to fall that way, then the next critical low that we need to observe, we need to see whether that gives support or not. That is at 43,230 is the level for that critical support. It actually provided a support on 22nd of November last year. That might be tested, as we hinted about this earlier also. And after that, a major low is located at 42,105, roughly 42,100 level. Bank stocks are likely to go down and test this Gann angle that you can see, that on the right side, the 43,000 mark, from where this line, the downsloping line on the headed leftwards, this might be tested. Banks are not performing for the simple reason that bank stocks are You may say that PSU banks are doing well. PSU banks are getting overstretched, but private banks, which had been the mainstay for the last 1 year, or maybe after the late March, early April rise, whenever the bank Nifty used to move up, the private banks were leading it. Those private banks are no longer performing in the market the way it had been for so many years. This time, the bellwether stock, the highest weight stock, both in the Nifty and in the bank Nifty, is HDFC Bank, and that HDFC Bank stock is very weak. It is not being able to take out that 1700 mark. In fact, 1700 mark is a far cry. It is not even managing to get past the 1550 decisively. So that being the case, and other bank stocks, other highly weighted bank stocks like Axis, like ICICI Bank and State Bank, they are also showing weakness. That's why the bank Nifty is likely to underperform. PSU Bank Index is doing pretty well, but my opinion is that PSU bank stocks are getting overstretched, and even they are getting ready for a correction, maybe not in this coming week, or it could happen this week also, or it can happen maybe a week later. But bank stocks are unlikely to perform immediately. Do not expect too much of a flourish in bank stocks. It is not showing that. On the contrary, it is suggesting that it might seek lower levels. CNX FMCG index. First, we would look at the daily chart, and then we would look at the weekly chart. First, let us see how the movement in CNX FMCG index happened over the last 4 months or so. On 26th of October, Thursday, it posted a low of 50,607, and from there the index started moving up and posted a top on 5th of January this year, and that time the high was 57,966. So what started from 50,607, it posted a high at 57,966, roughly about 8,000 points, and which would be something like 16% rise from the October 26th low. And 5th of January from 26th of October. So it is 61 plus 5, 66, and 6 days in October. Roughly 72 days it took to post that high. Now, what has happened after that is that the FMCG index, you've seen that a lot of FMCG stocks have been coming down. FMCG index has come down very close to the 50% retracement mark. 50% retracement mark is at 54,285.60, and the low recently posted was 54,507, very close to the 50% retracement level. Only 200 points left to be done. But why is this so very important? Even while we see that the 20-day moving average, the 9-day moving average, as well as the 50-day moving average, 50-day moving average has become flat, and 20-day and 9-day moving averages are still coming down. Yet, we are looking at a probable, at least possible, a possible turnaround in its fortunes might happen, because over the last 4 trading sessions, it is trying to clear not just the 50-day moving average, but also the 9-day exponential moving average, which is currently at 55,500. or it is even doing better. It is doing better. It is at 55,323 on last count. These two indices, that is the 50-day and the 9-day, which is located between 55,072 and 55,323, and it starts moving up, then the next resistance would be close to about the 56,000 mark, where the 20-day moving average is located, that is 55,969. The fact that it has come very close to the 50% retracement mark is actually giving some hope that, or at least some possibility, some signs of a revival of the erstwhile uptrend, because 50% retracement, after that people start buying again, because those who were not buying, such people think that good enough correction has already happened. No, now the stocks could well be bought, so those people might come in. So from that perspective, it is showing some signs of reversal in its fortunes. Now we come to the weekly chart, and this time that thing is even more clearly visible. What is that? After the green candle, that last green candle that you can see, that was 1st January, the week starting 1st January 2024, now completed 5 weeks. It has come down, and as I said, that is roughly about 48-49% kind of retracement of the last upswing that we saw from 26th October, from the 50,607 kind of levels to 59,966. That's kind of movement, 57,967, I'm sorry, that was the level of the high. But in 5 weeks it has given quite a bit of correction, and now the most significant thing is that last week it showed a doji. Doji pattern suggests that bears are undecided and the bulls have somewhat getting into fresh kind of a rearguard action. So chances are that FMCG stocks might do well. Keep a close watch on them. Now we are reviewing another sectoral index, this time the CNXAUTO index. CNXAUTO index is actually showing reversal, potential reversal pattern, the tweezers top pattern. Tweezers top pattern, how does it happen? When you see the stock or the index is on a rising mode, it is going up, and after a protracted upswing, after considerable upward movement, if you find that the last couple of sessions it produces almost similar highs. This time on Thursday it posted a high of 19,559.55. The very next day, that was Friday, it posted a high of 19,563.05. So it's roughly 7.5 points difference between the Thursday stop and the Friday stop, and both the days it closed much lower. Last close was 15,380, and on Thursday it closed at 15,328. So what's happening here is this, that this is called a tweezer stop, because it is as if you are using a pair of tweezers which is used in many to plucking things. They have the same edge, that is the pointed, sharply pointed two edges that are of same measurement. In this case, they are not exactly the same measurement, but very close. And generally, this happens, and especially when the close is considerably lower on both the days, that makes it a very important pattern. That is a potential reversal pattern. So this is a tweezer stop. It is now a potential tweezer stop. Why I am saying potential? Because it has not given its effect as yet. Only when the index falls on subsequent days, that is in this coming week starting Monday, if we see that the CNXAUTO index comes down, at least it tastes something like its 9-day exponential moving average, which is at 18,997. If it comes down by about 400 points to test that moving average, or fall even further down to 18,719 where the 20-day moving average is located, then this is definitely a reversal pattern, because the moving average supports are getting tested, which was not the case at least over the last many sessions, say 6-7 sessions. It has been not testing any of the moving averages. Even on the last count, especially on the last 3 days, the close is above the Bollinger Band, upper Bollinger Band, which is the +2 standard deviation band. Last 3 days the closes had been above that. So from there, if it were to come down, definitely it would be counted as a reversal pattern. From this week onwards, we are now going to do the weekend video only on the indices. We will take up the indices and look at them as to how they are panning out. Our individual stock studies, whatever we do, that would be published midweek, and there could be a couple of stocks or sometimes even more, and we would come up with that. Other educational videos, as and when they are prepared, they will be given to you. Thank you.